Good morning, ladies and gentlemen. This is Clueless 8, and this is a very important pre-market AM report for Thursday, December 10th, 2015. We are about to embark on a monumental, historical, and a very critical period of the market as we go into next week, Wednesday, December 16th, 2 p.m. We are about to find out whether or not the Federal Reserve Bank of the United States is about to raise rates, the federal funds rate, the discount rate, all the different rates that the central bank controls for the first time in 9+ years. Remember something about behavioral game theory. Just because you expect something doesn't mean you're not going to feel it when it happens. It's really as simple as that. The markets are ready for the rate hike. At least the U.S. markets are. I believe a lot of the volatility and the choppiness that we have seen in foreign markets is an adjustment to the reality that that an era of very free money and low rates is coming to an end. My belief, as many of the best minds in the industry have said, is that the Fed is not going to be on a rampant rate hike cycle. But keep in mind that if they're data dependent and we do see a sharp rise in inflation, for whatever reason, if oil spikes up big time and growth starts to come back in huge spurts, the Fed will be forced to raise rates at almost every meeting. Generally speaking, historically, if it's after the fourth or fifth rate hike, somewhere around there, that the markets really start to feel the brunt of the hit. After all, a rate hike is like slamming the brakes on a car. You're starting to ease back. You're starting to slow down the rate of growth. But in my opinion, we're still pretty far from that, given the anemic global growth and the U.S. Growth rate and the productivity and all that stuff, industrial growth that we have seen. It's a two-edged sword. In a way, you need growth to pick up. You need world economies to get back on their footing. But at the same time, you don't need a runaway train where the Federal Reserve Bank of the US and other central bankers will be forced to raise rates. Now, saying all that, let me give you a quick roadmap of what I think is about to happen. And I need everyone to remember one thing. This is a volatile market. It's a credit-driven market, and there were two extremely important and powerful articles that I tweeted out this morning that has to be read by every single person. Now, whether or not you understand the whole the details and the nuances of all global macroeconomics doesn't matter. You have to understand the gist of what's being written in those two particular pieces. Okay, they're right there on the Twitter feed. And just to remind people, those are the ones which, I'm looking at the screen here, bear with me. The article, it was posted an hour ago. It says Clueless PGT, Algo HFT Domination, Marko Kolanovic's market. We just traded it. Read that. The second one that you should read is the Fed could trigger a massive stop loss order in the S&P 500, and then I'm going to talk about that in a second. So very, very important that you guys get an idea that we're not just playing stocks in a vacuum. We're playing it within the grand design of a larger credit market and a high yield bond market, which is in a painful stage right now, primarily because of the collapse in oil, and secondarily because of the upcoming squeeze and the draining of the swamp, as they like to call it in the industry, of liquidity in the form of a rate hike. Emerging markets and developing countries generally feel the brunt of it, and if they do not take the rate hike in a positive way, we are going to have a monster sell-off in the global financial markets, bar none. So let's get straight to the technicals here. What we're seeing is I've drawn the channels. I've shown this chart several times. This is where we are right now, right there. So at this point in time, my feeling tells me in order to basically complete the first part of the pattern symmetry, we need to get to somewhere around 202 on the SPYs. I'll show this on the SPX in a second. So any type of move up right now, given the downtrending 34 in the 50-day moving average and the downtrending Bollinger Bands clearly seen in the form of these downward sloping green lines, okay, tells us that we are in a short-term downtrend. Unless we break out with another one of these huge what I call breadth thrusts or high velocity moves up, we are not going to get up towards these levels yet. The short-term game plan would be to sell into any quick rally, okay? Because I believe that before Wednesday, we are going to have these moving averages, and you can see what those numbers are, 208, 207 on the SPYs as major resistances. If we break out over this the downtrend line, this particular line here, this red line, then that's a different story. So one step at a time. Let me show you what I think might happen. We get up here, we fall, we don't we don't hold 204, and we fall to the bottom end of this support level, which is 202. At the 202 level, there are two scenarios. The first scenario is we do this pattern symmetry, which is a sharp move up towards 2100 or 210 again. The second scenario is that we basically move up a little bit, fail at the 204 level, and then make a sharp move down towards this major support level here. I believe that's around 1990. I mean 199 or so on the S&Ps. If for some reason we fail to hold this level at the 198 and change and 199 levels on the SPY, there's a high probability move that this particular pattern is retraced. So we are back to the 1860 bad old days of September 29th and August 24th. Is that a possibility? You have to be aware of every single possibility. Remember, this is a stock market. It is a risk game, and anybody who thinks it's a cakewalk is fooling themselves big time. I want to warn everyone, this is not a toddler's game. If you think you can just breeze in there, pick up one of the clueless recommendations, and just go away and come back a couple of days later and say, oh, wow, it got there. Well, it does happen. It happens a lot. But I'm warning people that the chances of that on this type of extremely nervous and volatile market ahead of the Fed meeting, you have to watch the screens closely. You have to do what you need to do on the trade management side and make money. We are still doing well. We have Chipotle here up $16. At one point, it was up $22. We play short-term moves intraday or on a multi-day basis on certain stocks. We do extremely well. Remember, the Fed's game changer in raising rates does not change the trajectory of the market, which is still a bull market for now. Okay? What it does change is increase on heightened volatility, so that everybody is nervous, on their toes, and of course that's the reason why you need my service, the Clueless Day trading service, in order to keep some sanity in this game. So let me recap the probabilities again. If we break out over the uptrend channel, the downtrend channel here, then there's a good possibility we move up real fast and furious towards the 211 level on the SPYs. If we get there, you sell hard. The red arrows, I'm going to put another one up here. At this point, looking at the downtrending moving averages, the Bollinger Bands, I'm just recapping everything I said in the last couple of minutes. There's a good possibility that we hold the 204 and bounce. In that case, that would be a dragon bullish pattern that I talked about. Or we break this and move down quickly towards the 202 level. Now remember, as active traders, you don't need to sit there and watch. You can act on it. The difficulty is that the algos and high-frequency trading programs make sure that most of the market direction is hedged and masked because they constantly keep on spoofing and doing things to screw up traders and investors. That's why there's never a green light before the market goes up or a red light before the market goes down. That's the reason why the Algo HFT charts that I keep on telling people to get are some of the most important tools that are in my arsenal that I help people with in order to determine market inflection points up or down. These charts are very good too. And of course, Thinkorswim is there, which I'm going to show in a second. So that's the bottom line. If we do not hold the 202 level, I've already showed you the scenario that we're going to try to come down, hold 199. We failed that. We're down to 1860. You get a nice directional move or even parts of it. That's a significant amount of profits. And we all know that. on both sides. So at this point, this is the chart that you need to focus on. The internals are saying that we are going to go up a bit more. So in my opinion, which I've said yesterday, we probably get to 207, 208, and then we fail and we come down again. By that time, we should be overbought on the 1 hour chart, and we go from there, one step at a time. Let's take a look at the S&P, the E-minis, as we are seeing in front of us right now. This is the live E-mini, obviously, the S&P futures, and we're seeing that right behind us. I believe we are up 5 or 6 points on the E-minis right now, and this is where we are. So let me go ahead, and you can see the big moves here. This was the huge crash. And by the way, that article about from Kolanovich, the one which says Clueless PGT Algo HFT Domination, is probably one of the best pieces I've read in months, because that completely solidifies my theory that I always explain to people and want them to understand that this is a machine-driven market, and that and all these different variables that drive the markets underneath the surface, underneath the stock market, the credit markets, the global currency markets, and all that stuff, the oil markets, are what drives these algos to do what they need to do. And that article sums it up. And he's from I believe he's from JP Morgan, and he's brilliant because he's a quant. And I think he's one of the first guys who says it the way he sees it, not just flowering up the picture, but talking about actual numbers and quantitative algorithmic high frequency trading maneuvers. So saying all that, this was a big crash. This is the one August 29th. He talks about all this in the article because he predicted it, to be honest with you. And then the big move up. This is the big move up. Nice little corrective move. So that corrective move, whichever way you slice it or dice it, looks like 2000. Okay, on the E-minis, because that's pretty much what it comes down to. Right there. And that should set us up for a nice little rally up towards the 2100 again, if you can visualize this. All right, so it is going to be a very tactical market. You got to keep trades, in my opinion, somewhat moderate. Swing trades, you go with whatever you need to do. Don't get overtly bullish, and don't get overtly bearish, because dogma doesn't pay bills. You have to be flexible, and you got to do what you need to do. Do not expect a linear market, straight line up or straight line down, because that's exactly what you've been learning every single day. And even through all that, we've been delivering some spectacular results given my tactical alerts. The next thing I want to show people is basically the calendar. Extremely important. This calendar I've put out with markers so everyone can see it. It's a kindergarten version, which basically shows all the important market moving economic numbers. And most importantly, on Wednesday, December 16th, 2 p.m. and then the 2:30 p.m. press conference. And that is the biggest pivotal moment. In the meantime, expect a volatility cluster. In other words, severe volatility that should kick off starting Monday. That's why it's in red. And we have a massive monthly options expiration, quad witching, quadruple witching. Want to know what it is? Google it. This is going to be huge. Now, one of the key things, that article that I put out there, is it says Fed could trigger massive stop loss order. That's another article. If you don't read it, you're fooling yourself, and in my opinion, you're being totally stupid, because it talks about the fact that how many puts are out there in the market and what could happen on the quad witching hour. It could be a massive move down, or in my opinion, a massive move down and then up, given the fact that the shorts have to cover. So expect a dramatic move down, in my opinion, at or around the Fed meeting, and then buyers come in and move the market up big time and probably hit that 2100 level or close to it by quad witching. Monthly options expiration in general is 70 to 80% a positive bias event, but it never gives you the green light. Okay, so get ready for some severe volatility. Have a great day and stay clueless, stay trading. Need everyone to sign up for the advanced group sessions so they know what the heck they're looking at and maximize the power of the Clueless 8 trading charts. Thank you for listening.